Okay, greetings everyone. I want to take this opportunity to answer a number of questions that have been sent to me recently, and I want to try and tackle them all in one go if possible. The first one is this, regarding just what kind of market benchmark and discount rates you should be using. The question is, I've been chatting with my roommate about the effectiveness of models in forecasting the future, and we are baffled by the fact that Bloomberg suggests CSI 300 and the 10-year China government bond yield as market premium for H shares, which is kind of which is consistent with what we've been saying also in class. For me, or the person asking this question, it's not so obvious why CSI 300 should have anything to do with the performance of a stock listed in Hong Kong Exchange. And if we were to do that, then all those red chips and private companies, they may well have business in China, but I don't think their performance has anything to do with CSI 300. Now, this is a difficult question. So, when people set up these pricing models, you have to understand they start from very simple assumptions, as you must. So all the companies are expected to just be located in one place, and then the business also is done in that place, and so on. Regarding the first or the second paragraph, I tend to take the opposite view, which is that I think the way you should determine the discount rate and the risk premium and so on really depends. It should depend less upon the place where your shares are listed, and it should depend more on where your major business is run. And you have to understand, if very often actually there are a lot of companies where their main business is done in country A, but they list their shares in country B, in the stock market of country B, and the reason is very simple, because country B is where the capital is where the tradition lies. Okay, a lot of tech companies, they list in NASDAQ, even though their business may have absolutely nothing to do with the United States whatsoever, because that's where everyone else is. That's where the money is, and that's where the valuation expertise is. Now, I guess Alibaba is a good example of that. Okay, Alibaba is predominantly, a business with, income in domestic China, but they are listed in New York. And in the end, the question really to ask is, when you are trying to come up with these discount rates, what are you trying to do? What you are trying to do is to discount future cash flows, and these have to be based on the risk of those cash flows. Okay, and if you are running a business in China, then your risk clearly lies with China. There are other examples. I'll give you another one. Standard Chartered Bank, for instance, which you all know quite well, because when you are here in this city, you turn the corner and there is a Standard Chartered somewhere. Now, do you know where Standard Chartered Bank is listed? It's actually listed in London. So it's registered officially as a British company. It actually has what we call dual listing, and you'll learn more about that in capital markets next term. But the primary listing is in London. They have not much to do with the United Kingdom. I mean, they have some connections there. Um, I don't think you find many branches of Standard Charter in the UK. I don't know if there are any actually. There might be some. So here's another example where Standard Charter is basically an emerging market player with a very strong sort of Asian flavor, and a sizable chunk of its business being done out of Greater China, meaning Hong Kong, China, Singapore, Taiwan, and so on. So I would I would say that overall your risk premium and your discount rate considerations should really be based upon what is the risk, the business risk of your company, and not the listing jurisdiction. Okay, thank you for the question. Okay, now for the next question, which is actually a little bit lengthy, but somebody was sharing with me some findings that they came across when they were doing the project for IPA, which I have reproduced here without the identity of the person. Now, I think the general question really is regarding stock or equity research and equity analysis and valuation and so on. It seems that this student is saying that there appears to be apparent sort of data massaging in the industry, because they kind of felt that the valuation that they got was quite different from what they saw outside. And the question is, I wonder, is this very common among the industry? Well, I'm sure there's some of that going on. If you have been reading some stories, I think the problem, one problem, the equity research industry, one problem it has is that apart from wishing to be truthful and objective, it also has other, potential commercial interests that are influencing, what they put out. So that's one thing. However, I think you don't have to be too bothered by that, because there are a million people out there analyzing, companies and stock prices, and sell side research is just one part of it. You could be, working for a mutual fund. You could be an analyst there, and I know I have friends and I know some students who are doing exactly that, and they really enjoy doing it. So if you are from the buy side and you are analyzing companies, you have absolutely no hesitation, whatever, in writing off a particular stock if you think it's not really a good investment. If you are from the, if you are in hedge funds, not only would you have no hesitation to be negative on something, you'd be happy to short sell. So you really have to have no compromise. I think it may well be true that there's a bit of mediocrity, or people who may not be very good in the in the research analyst industry. I wouldn't say that everyone was bad. I would not do that. and I don't think you need to be too concerned either about the general quality of the work that you see out there. The way I see it is a little bit like this. So these days, let's take the music industry as an example. Now, I don't know about you, but for my money, there's a lot of rubbish out there. There's a lot of crap, and a lot of things that are not even worth spending 2 minutes of your time listening to. And yet, if you are an aspiring artist, if you have ambitions, to become a professional musician, do you really care about the amount of rubbish out there? No. What you should care about is whether you yourself, whether you believe that you are good or not. That's what matters. Not what is the general standard out. If there's a lot of rubbish out there, that may well actually be good news. Now, of course, I don't really mean that entirely, because if the standards are out there are very good, that can quite often serve as a motivation and inspiration for you to reach a higher level of excellence. It is true, okay, but even if the standards were low, like in the pop music, every now and again, there's some truly talented artist that comes along and produce something, and you listen to it and you say, wow, what is this? This is amazing. Okay, so that's the way I look at it. Is not to be too concerned about the general standards of excellence out there. You should look more into yourself and ask yourself, am I suited for this industry, and am I good at it? Okay, that's what really matters. And I was thinking that so there are people who would argue that analysts and fund managers are not really very good, because it seems that they find it so hard to beat the market and outperform. Now, so that's one sort of charge or accusation that people often make. Now, on the other hand, you quite often hear people say that markets are priced accurately and fairly. Okay, now when you on first impression, you could say that these two, they seem to be, there is some kind of a contradiction in there. Okay, so if analysts are not good, if they produce a lot of rubbish, then how is it possible that markets are fairly priced? You might be asking. And I think one possible way to think of this is that I think there is a difference between trying to work out what a company is worth, given all the, let's just say, publicly available information. There is a difference between trying to work out the fair price. So if a company is worth $10 and it's the worth, and it's priced at 5 in the market. Okay, now sooner or later, I think analysts are able to identify the gap, and sooner or later, there will be a convergence, and the price will slowly drift back to fundamental value. Now, there's a difference between doing that and being able to price everything according to what it's worth. There's a difference between that and then needing to sort of take that one step further. And I think this is where a lot of buy-side research. If something is worth $10 and it already is priced at $10, I think some analysts are compelled to sort of talk it up to like 12 or 14 or whatever, okay? Because if they don't do that, then the clients will be asking, well, why am I holding on to it? Or why should I buy more of this, and so on, okay? So there is a difference between trying to identify what is the fair value, and I think on the whole, I think analysts, I think they do an okay job, okay? But once you get there, and you still ask me, where is it heading? Now that is quite similar to really asking me to forecast the future. Now that's a completely different game. I can't even tell you who's going to win the presidential election, 2 days from now. And yet, quite often, when you have to make these uh, wild guesses and takes on and taking on increasingly um, uh, wild assumptions, or making guesses at things where a wide-ranging number of outcomes are possible. I think that's when you see analysts failing to accurately project the future. Okay, so I don't think equity research is a complete waste of time, or asset management for that reason. No, I don't. It's really how you look at it. You should just look at your inner self, your own self, your capabilities and your interest. And the second thing is, I draw a distinction between being able to price a stock fairly when it clearly is, when there is a substantial gap, between what it's really worth and what the market is pricing. I think overall analysts are okay doing that. It's only when something is already fairly close to the fundamental price, and that's when people start having problems. Okay, so I hope that at least will make you think a little bit about this question, which I think is important. Okay, now the next question is regarding CAPM, and I have a question about the proof for CAPM when we compare the main difference between CAPM and APT. It is said that in terms of the proof, CAPM uses the Markowitz approach to maximize utility. I can't quite understand the relationship between the Markowitz approach and the CAPM, since I think one of it for finding the optimal risky portfolio, but the other is for asset pricing. How to maximize utility to prove the CAPM? I think to answer this question, you have to first of all look back. So this is page 7 of lecture number 8, which is the lecture about chapter 10. So Markowitz approach, you maximize utility in CAPM. Now, one thing to remember is the CAPM is a kind of equilibrium model. So that means it's based on some fairly strong assumptions. But if these were satisfied, then it can be demonstrated that the market will converge to what the CAPM actually predicts, which is RI is equal to RF plus beta times market premium. So it will converge to that if the assumptions behind CAPM are true. And to understand what these assumptions are, I think you have to go back to the lecture before, lecture 7 on chapter 9. So the key assumption, of course, is that there is an efficient frontier for all kinds of stock portfolios given a certain risk, a certain sigma. There is always a maximum return that there is one unique combination that will give you the maximum return for that risk. That's just a simple statistical concept of constraint optimization, I guess. Okay, and then more further to that, then if you were able to invest your money, where if you have $100 and you can invest zero, or you can invest all of it somewhere along the efficient frontier, okay, the green curve, okay, then you would want to invest in the point where when you draw a line from the risk-free rate, it touches the efficient frontier at a tangential point, because that point will give you the highest return per unit risk. And then it's really a question for you. So that, because of that, then collectively, when there are hundreds and millions of people collectively, and some would like to borrow, some would like to lend, but if overall the average investor, okay, would be at this point, so that is what this therefore has to be the market portfolio. Now, this is actually based on another concept a few pages later. So this is what we call the separation theorem, which is quite neat. And the separation theorem is simply that you would always want to invest, or the average person, okay, if they were to invest all their wealth in stocks, then they would invest in this at this point, which gives them the best return for the risk that they take. But whether you want to invest, you want to borrow and invest more, so you are on this side, or whether you want to lend money out and invest less in the risky market, then you are on this side. Okay, now that is entirely a matter of choice for yourself, and what drives that decision is a matter of your own utility. However, which is based on your degree of risk aversion. Okay. However, you will always want to maximize your utility, and therefore, a couple of slides later. So, one investor may well have these are indifference curves. So they may well have indifference. So this is a curve where you are indifferent for all the possible portfolios on this red line. If your risk aversion factor is equal to 1, then you don't mind to take a lower return and lower risk, or high return and higher risk. Now, the thing is, so this is one investor. Now, another investor might be more conservative and is happier to consider any portfolios on the blue line, which would give them, again, different returns versus different risks. Okay, now, and you should know how to determine, or at least where these curves actually came from, because we did that in tutorials earlier, and they are related to your risk aversion function, and also how much you end up, how much, what proportion of your wealth you end up investing in the stock market, and so on. So we assume, and this can only be true if all investors actually seek to maximize their utility. Now, what does that mean? Now, I've tried to redraw the graph here. I'm so sorry. It's quite it looks a little bit messy. So this line here, okay. Now this is the efficient frontier, and this, I know it doesn't look like a straight line, but this is the line which is the capital asset line. okay, or capital allocation, capital market line, sorry, CML. Okay, now for a certain investor, they may have indifference curves that look like these ripples. Okay, so for every one of these, I'm happy to take any of these portfolios, but this one has the highest utility, of course. Okay, and the second one, this one has slightly lower, and lower still, and lower. Now you can keep drawing these until you get to an indifference curve, which is actually touching the capital market line, let's say at this point. Okay, now you can't have these other portfolios because they're not actually available. Okay, which is to say, for this amount of return, it is not possible that you only assume this amount of risk. I'd like to have that, but it's not available. Okay, even though you specified an indifference curve, but this one certainly is available. Okay, now if you keep drawing these ripples, RIPPLE, okay, you can actually keep going. Okay, you can keep going, but the rational investor will stop at this one. This one. Can I use a different color? Let me try. Oh, they all change color. Damn it. So the rational investor will pick this one because this is the first one that is touching the capital market line, and therefore this indifference curve is the highest utility indifference curve that is currently available because it touches this line here. Okay, so that's what we mean by saying that investors, and this is, actually part of the sort of theoretical foundation of CAPM, that every investor will seek to do that. So let's say this is actually, let's say this point is the market portfolio. Okay, so every investor, so some investors, if they are conservative, they might be over here, but even if they are over here, it doesn't matter. Okay, you can keep drawing the indifference curve. So this investor will want to invest here. Okay, think of it like this. So let's say the market is worth $100. Okay, and investor A, okay, investor A has $100, and investor B also has $100. Okay, so what are they going to end up doing? Well, so let's say this guy is investor A, this guy is investor B. Okay, so A may invest, let's say, stocks and cash. Okay, so A might invest $70 in stocks, and then $30 they will lend out. And then for B will actually invest $100 plus $30. Okay, so A is lending, and then B has to borrow $30. Now CAPM carries a lot of these equilibrium considerations to the extreme, and it assumes that all investors are rational. They will want to maximize utility, and not only that, in the end, ultimately, it becomes the greatest zero-sum game in the world, which means that there's no sort of net lending or borrowing. So you can see that in this very simple example. Okay, if one investor has $30 of spare cash, A, and B wants to borrow, so it becomes zero sum, and then the borrowing and the lending will net out in the market, and also there's $100 worth of stocks, and that also will net out. Oh, sorry, I beg your pardon. The market should be worth $200, not $100. Okay, my mistake. So $200 and then $200 of assets, and then $200 of wealth, and then because some of them will invest less in the market, so the spare cash goes to the person who wants to invest more. Okay, so all of these things, they go together to make up, what is known as the CAPM. Okay, that's how it's related. Okay, so investors must feel the need to maximize their utility and choose the best indifference curve available, which is the first one touching the capital market line. Okay, so if you have a problem with chapter 10 of lecture number 8, just go back to chapter 9 of lecture 7 and take a look there. Okay. Now, let's take a look at the next question. Now, this one is regarding the difference in returns between value stocks and glamour stocks. Okay, so in the PPT of chapter 11, page 20. So chapter 11, page 20. So there's a chart here showing the difference in performance between value stocks and what we call glamour stocks. Okay. The question is, according to the professor, the actual EPS of growth stocks, though lower than expected, is higher than the actual EPS of value stocks. Professor interpreted this chart as it shows the gap of value and growth stocks is narrowing. I can get it, but still confused about the concept of EPS and its interpretation. Well, I think first of all, please understand that this chart is showing you the actual stock price performance of value stocks, which are supposed to be the good old boring stable companies that are cheap with stable earnings and so on, versus the glamour ones, which will have a high valuation versus the book value, for example. Which means they are expensive, and they're expensive because people expect that they will have a higher growth rate. Now, this is stock performance, okay? Performance of, so that we are mainly focusing on how the share price evolves over time. It may well be true that earnings per shares of growth stocks are higher. So, but if the stock price itself, okay, is already very expensive, then in the end, even a high earnings per share may not compensate for that. I think that is the key point. What the methodology which is being used here, all they're doing is at any moment in time, okay, they would take a look at stocks and then divide them into two categories: value stocks versus growth stocks, and then every year, at around the time when they announce their earnings, then they look at the stock performance, the stock price performance, okay, and they found that generally the performance of glamour stocks seem to sort of lag behind value stocks. So that means people have priced in too much, So generally they are disappointed, and they're disappointed because they pay too much to start with, which is the whole point of this graph here. Okay, and in fact, if you read the textbook where this the Bodhi textbook where this graph came from, you get the idea that let me just save that. Okay, I'll save later. You get the idea. You get the idea that so let's say you define value stocks. So value stocks and growth stocks. So if you were to use the book value divided by the market value as one possible measure, okay. Now value stocks are where this valuation metric tends to be higher, okay, and growth stocks is when a company, the market value might be quite expensive. So as a whole, then the book versus market ratio would be lower. Now, if you read the book carefully, they seem to be saying that this measure here has a positive correlation to future growth. So that is to say, when this ratio is very high, then there is the growth prospects of the company in the future is actually higher. In other words, when this number is very low, okay, so that means the company is expensive, the denominator is bigger. It doesn't reflect very well on the future growth prospects of that company. That's actually what the relevant section in Bodhi was saying. Okay, so this is just talking about the stock price performance. It's not really focusing on earnings per share. Okay, regarding the question about where to buy good books, well, I'm probably not the person to ask anymore, because I buy a lot of books these days electronically via Amazon Kindle. I'm wondering where to buy one in Hong Kong if not from Amazon. Well, one of the best bookstores I think in town is located right on campus in the YIA building. I love hanging around there. There are good bookshops on top of the Mongkok East railway station, for example. What's that place called? New Century Plaza, something like that. Or on top of the Kowloon Tong station, there's a bookstore there called Page One. In Tsim Sha Tsui, there's a very nice bookstore called Changping. My pronunciation is not good. So that place, the location is not so great, but it's a great place to hang around for an afternoon, I think. But I buy my books mostly on Amazon. Amazon Kindle, that is. Could you share with us some websites or YouTube channels to get some everyday financial news? Well, I've already said this before. Try. I think Bloomberg is the best bet to begin with. They got so much stuff which is free. You can try also Reuters or CNBC, although I don't believe CNBC is as good because they are a little bit biased. But Bloomberg, I think, is quite good. Financial Times also has plenty of free stuff for you to look at. Okay, now let me get on to question number 5. Sophie, hi Sophie. I have a question regarding this week's lecture. I remember Professor Fong mentioned there's less research on small firms, so investors demand a higher return because of this. However, if small firms provide the same information disclosure required by a stock exchange as big companies do, why should investors demand a higher return just because less analyst coverage for whatever reason? Now, I think this is a good example to demonstrate quite powerfully that there is actually some value to analysts' research and equity analysis. I think we take it for granted. When, let's say, the stock of HSBC is currently 65 or whatever, and analysts are saying, okay, that's fair value. Okay, I think we tend to we take for granted and we underappreciate that HSBC is 65 precisely because so many people are looking at it and hammering away and trying to work out what the price should be. So in the end, you do get some kind of efficient market, which is also why when you guys are doing your project, we asked you not to pick a company that is too kind of conventional or middle of the road that everybody knows about, like MTR or PetroChina, HSBCs, boring companies. I think the point to remember here is information disclosure required by regulators is quite different. It's quite a different thing from equity research. Okay, if we actually can determine the price of a company simply by looking at what they are legally required to disclose, there really would be no need for any kind of stock research at all. Any, okay, big firms or small firms. Now we know that not to be true, and the best example I can give you is if you just step back for a moment and look at the fixed income world. So a company can choose to get a credit rating from Moody's or S&P or whatever. Okay, I mean they have their faults as well, but there is some value to that service. So a company can get a rating. Now, you think of two companies, everything else identical, okay, and they both want to issue bonds, and they issue bonds with the same maturity, okay, a similar structure, and one company actually has a credit rating given by Moody's or S&P, which means they've had the company looked into by experts in credit risk participation, and then the other company that does not have a credit rating. Now you tell me, if you are the investor, are you actually happy to buy the bonds of both companies? Are you indifferent to the bonds of these two companies, A and B? You can't possibly be. Okay, the company that did not get the credit rating, okay, so they have not really been thoroughly examined by anybody. Okay, so if you take a gamble, sorry to use that word, okay, but if you take a risk, there are potentially things that may not have been looked into. So I think the more scrutiny there is by market participants, the more likely it is that any scandal, any mispricing, any gaps, any weaknesses in the company will have been identified. Okay, so I think the information disclosure requirement, and a thorough, valuation or business analysis, they are different things. You would not be asked to disclose, when you are filing for stock exchange listing. You will never be asked to disclose, your business outlook or your strategy or your competitive advantage and prospect of the market and regulations and so on. So none of that stuff. Okay, so disclosure requirements are fairly clear cut and basic, which is something you will learn, by the way, in capital markets next term. All right. So I hope this answers all your questions. I do apologize if I don't give instant response to you when you write to me, but I always want to try to give you some good feedback on your questions. So I don't want to compromise on the quality. So sorry if sometimes I need to take a little time to produce these videos. All right. Thank you very much for your kind attention. Thank you.